Federal Reserve has a model of how they value stocks, and if we look at the implied return from the Federal Reserve, that's this blue line. That's what they think should happen the next year, and the purple line is what did happen the next year. And they're pretty good at that. When they think next year returns will be good, they are. They didn't think they'd be so good, they were. They thought we'd have bad returns, and we had bad returns. The Fed model, which my friend Vic Niederhofer developed, I believe, with he and Laurel Kettner, his wife, and now has been popularized by Ed Yardeni, has a pretty good record of telling you when to be long stocks and when to be short stocks. Question?
How do we access that?
You can access the Fed model, Google it. Ed Yardeni keeps it up the most now, but it's a relationship of 12-month forward PE ratio and interest rates is what it is. And it's been a pretty good record on a long-term basis of suggesting to us what will happen in the future. In the printed material, which you'll be reading at home or when you get our download copy, I have a lot more information about it. So you'll see the where to Google and all that will be in the manual. But it is an indicator I do look at. It helped me immensely sidestep a lot of 2008 and get in the 2009 bull market and stay bullish ever since because of the Fed model. So we did have a question on how we're going to invest our money, and we want to look at how we want to buy equal shares or equal stock. We did a survey on that. We looked at the Dow equal dollars versus equal shares. We just bought the 5 lowest price to sales stocks from 1975 to 2004. We did them on equal dollars invested or equal shares invested, and look at the difference. The average return equal dollars was 7.7, equal shares 5.3. That's 20% better buying equal shares, equal dollars, not equal shares. The deviation on the downside was 15% down versus 21% down by being invested equal dollar amounts versus equal share amounts. So clearly when you're ponying your money up in your longer term investments, you want to make certain that it's equal dollar amount in the 5 stocks or the 30 stocks or whatever your basket is going to be. And I would certainly recommend a basket, not just one stock, unless your brother-in-law is the president. Then maybe you could be in just that one stock. But short of that, one stock bet's a really dicey bet. Tough roll of dice. So clearly we want to be invested equal dollar amounts in each of our criteria. Got it? We looked at insider buying in the Dow Jones Industrial Average, and insider buying is actually very positive in the Dow. If you look at the average return of the stocks with the highest insider buying in them, you're 19% on a 9-month return. And it looks like a really good strategy for the Dow, but it isn't, because there's not a lot of insider buying. Remember we looked at the insider buying a little bit ago, and I think Walmart had a lot of insider buying and the rest of them very little insider buying in the Dow. It's much more demonstrable in other markets. And where insider buying works is not when they sell, but when they buy. There's only one reason to buy a stock. You think it'll go up. There's 1,000 reasons to sell it. You're getting divorced. Your kids are going to college. You want a car. Maybe you think the company's falling apart. That could be one of them. But there's a lot of reasons to sell a stock. You need an addition for your house, whatever. That doesn't mean you're bearish on the company, but buying it means you're bullish on the company. So insider buying is a really good relationship to look at in the market. It's just that in the Dow, it beats the Dow, but the insider buying is very erratic. There's not very much of it. So I couldn't put together a real strong insider buying strategy in the Dow Jones Industrial Average stocks. Negative earnings. This is really interesting data. Over the last 30 years, stock prices increased 6.5% in quarters with negative earning growth and only 1.9% in other earning periods. Whoa. What did that say? Stock prices increased 6.5% in quarters with negative earnings growth. You would think that would be bearish. Actually, negative earnings growth, especially when they build up, can be quite bullish. You'll be shocked in a moment. Does anybody know the best year that we've ever seen in stock market performance in the history of the United States? When did that occur? Be interesting.
1931.
Pardon?
31.
Yeah, you'll see some years when it's like, well, that's interesting. So this is another one of those when it's bad, it's really good. These are the rates of change of jobless claims versus stock prices. Stock prices are in green, jobless claims are down here. Notice what happens to stock prices when we have a lot of jobless claims. Stock prices rally. So when jobless claims are just falling apart, nobody can get employed, oh my gosh, buy stocks. That's one of the best all-time buy signals when the economy is that bad. What are our friends at the Fed going to do? Do they want homeless people in the street? No. A few? Yeah, except a few. I don't know, we were in San Francisco the other day. They're different. The homeless people in San Francisco are really different than any other place I've seen. But we just can't have that high of a level of unemployment. So they step in. Whether they should, whether they shouldn't, I don't know, but they do it. And when we look at this history going back to 1968, that's the record. So high levels of unemployment are incredibly bullish in the marketplace. And when that happens, you'll feel very black and very blue. People are out of work, nobody can get a job, economic times are bad, and that's when you buy stocks. You have to turn your whole world upside down. What a wonderful business we have being stock buyers. It's got to be the best business in the world. I can't think of a better business. When things are bad, we're happy. When things are good, we're taking profits, we're happy. How many of you work for somebody, have a boss? Anybody here have a boss? You guys like your bosses? Not a lot, right? How many of you are bosses? How many like your employees? Yeah, same thing. Look at that. Bosses and employees are something in common. They don't like each other too much. But here's what another thing they really have in common, neither of them like customers. So in our business of trading, we don't have any boss, we don't have any employees, and we don't have customers. It's just me looking for stocks with low price sales ratios or low forward PE ratios. That's it. What a great business, and not much capital to get involved. They need a computer, a laptop. I can do it from any place now. Oh, this is the greatest business in the world if you understand how the business works. So high levels of unemployment are associated with major stock market bottoms. So if I see a negative employment, I'm going to buy stocks, whether my 13-week rate of change is there or not. I want to be fully invested for the next huge up move. 1933 was the best year of stock market performance in the history of the U.S. Unemployment that year was 25% unemployed. And that was when stocks really took off to a run to the upside. Again, really bad is really good. But it's so hard. I've walked through the valley of death. You know, I can remember being in New York City and when I lived in Carmel, in California, being in San Francisco at the 1966 bear market low. You could just cut the air with so much pessimism, and people were upset, and oh, it's just, you can just feel it in the streets. It's so negative, and you've got to be positive. Don't tell your neighbors how happy you are. They'll get upset with you. I found that out. Well, what about that unemployment rate? How important is it? Well, when the unemployment level is above 9%, stocks appreciate at 24.5% a year. How good is that? Woo-hoo. To be bad? Yeah, well, come on, high levels of unemployment. Boy, your neighbors won't like you at all when you start rooting for that. But why that works is because the Federal Reserve System then comes in and they take action. They take big action. Increase money supply, lower interest rates. Presidents do things. Congress will put all sorts of build dams, rivers, bridges, whatever, because they've got to get the country moving again. And they start to do that at high levels of unemployment. By the same token, when we're below 5%, we don't do so well. Right now, we're probably somewhere in this area, depending on whose numbers you believe. So we're in an area that's not an actual bad area. We have unemployment, but it's not a high level, not a low level. We're just muddling along in here. That's good for stocks. So here's the unemployment sell signal. Because when everybody got the job, you got to be very careful. And this is really interesting. If you look at the crash that we had, the red line is the S&P 500, right? And when unemployment starts to pick up, people are starting to get jobs, look what happens to stock prices. When unemployment starts to pick up, stocks decline. Unemployment starts to pick up, or employment rather, starts to pick up, stocks decline. So as people start to go back to work, that's the sell signal in the market. You got to be careful of, right now, unemployment levels have been coming down. You can see where they are. It looks like we've gone from 10% unemployed down to 5 or 6, depending on what you believe. When it turns up, shortly thereafter, look for a stock market top. So we can use unemployment for sells as well as buys. When things start to get good, we go, oh, where's the door here? See you guys later. It's a very good long-term indicator. I didn't hear that. Repeat it? Sure. The blue line is unemployment. So people are highly unemployed here. They're getting jobs. Uh-oh. It starts to tick up a little bit. We're close to the end of the move in the marketplace. Another Federal Reserve report. The Federal Reserve has shown us the future of the stock market. Some of you have seen this with me already. You can listen to Vice Chairman Stan Fisher. When people enter the 35 to 49-year-old age bracket, they make more money than any other time in their lives. When the peak earnings years are also peak spending years. So demographically, when there are more of these people in the 35 to 49-year age bracket than any other bracket, there's a lot of spending in the economy. Their group isn't always in control. Sometimes there's a lot of kids in the market, or sometimes a lot of old people that are the bulk of the demographics of the marketplace. But 2015 kicks off an economic wave when the middle-aged group, 35 to 49, will outgrow the younger group. This ratio is set to last to 2028. The spenders are in control from now into 2028. That's the demographic breakdown of our society. It doesn't mean we're going to rally every single day, but it does mean the Federal Reserve has shown us the future. This is their forecast of the market based on PE ratios and what group is in control. And their forecast was PE ratios would be high, come down low, bull market into about 2000 and come down again. That's their forecast of the market. Their forecast for the market now is low PE ratios. They're showing now this PE ratio stays low until about 2028. We should be bullish on balance because the spenders are in control of the economy. What does that mean? It means consumer-driven stocks. Starbucks, Nordstrom's, Target, even Walmart, where people are buying stuff. The consumers have money. They're going to go buy stuff because we have spenders in the largest bulk of the economy now and will be for some time. So that's really positive long-term bullishness for the marketplace. Now we'll go look at our next stock. What difference does this make? Well, quite a bit. In 1950 to 1965, this middle-aged group was in control of the economy, 4.6% earnings growth. Then in 66 to 82, the younger kids, my generation, got in. We lost 2%. Then 1983, the middle-aged group got in, 14%. 2013, younger generation got in, we lost 4.9%. We're now the middle-aged group. So we're really lucky, especially young kids, because this middle-aged group is going to buy stuff, because they have money. The kids are out of college, they have most of their debt liquidated, they're going to go on holidays, they're going to buy things. So it's a very good long-term fundamental condition that we're in right now for stock investors.